mid-year economic review, which is now tabled in Parliament, and a couple of statements which are coming in, which are where the government has reiterated its FY16 GDP forecast between 7 to 7.5%. So this is what they're expecting, and this is largely in line with what the brokerages and the entire economist community is also expecting. We have Lata with us, joining in to take us through the mid-year economic review. Lata, not market moving too much?
No, not market moving, and not even very surprising. But the whole issue is, if the mid-year forecast has kept the GDP at 7 to 7.5%, and considering the GDP deflator, last time we got a nominal GDP growth of only 6% in a quarter. So that will put some strain on the fiscal deficit, which envisages a total GDP of 11% growth, 11.5%. So if it is not 11.5, it's a 6% growth, then it will be, 3.9% of a smaller numerator. I would really want to know whether there are any details available on the fiscal deficit front. It's a little difficult to react with just about a couple of statements coming in. The manner in which the whole survey is released, it's a little difficult to get much details. You just get a large book, and that to some wire agencies, and all you get to react are a couple of phrases. But not to worry, actually, at 12:30, the Chief Economic Advisor will hold a full-fledged press conference to detail how the government has looked at the year so far. What are their tax collections and what are their likely tax collections? What are the likely fiscal deficit? Will there be a cut in planned spending? We'll get to know a lot at the press conference, so you can make a better assessment of the second half GDP. But we have Deepali Bhargava of Credit Suisse joining us on the phone line. Deepali, good afternoon. Thanks a lot for joining us. We really have actually only one sentence to offer in terms of a highlight coming from the mid-year review by the government of its own finances and the economy. It says that the GDP growth has been forecast at between 7 and 7.5%. Any reactions? Will this make the nominal growth lower and therefore the fiscal deficit tougher?
Hi, good afternoon, Lata. Actually, yes. I mean, even nominal is frankly, even real GDP growth numbers that they've given is slightly lower than our expectations, which should mean that the nominal growth numbers that they have budgeted in should also be lower. And I think the difference this time will be pretty significant, because I think you're looking at a difference of a good 5 percentage point in nominal growth compared to where they are and where we might end the year with. So usually what happens is that the difference in nominal growth expectation versus actual doesn't make an impact, but this time it will make an impact. So we're actually looking at about a 0.1 to 0.15 kind of a slippage just on the basis of GDP measurement.
So that would be a higher fiscal deficit, or the need to lower the market borrowing and the fiscal deficit number by 0.15% of the GDP, right?
Yes, absolutely.
Okay, so that would work out to what, some 10,000 crores?
Yes, so that should be actually slightly higher, close to 200 billion.
Okay,
so,
20,000 crores.
Yeah.
Okay. I'll just come to you in a minute on whether this will mean a cut in planned spending at all. But Siddharth Sanyal of Barclays has also joined us. Siddharth, actually we still have, okay, do we have more numbers?
Something about inflation which should come up, where they expect inflation and a target on inflation. It's about to be 6% in FY16. So retail inflation likely to be about 6% in FY16.
Wow, that's like, almost seeming to agree with the Reserve Bank. The Reserve Bank's forecast stands at 5.8 to 6% January to March, and they were expecting it to be undershot. At least for now, since we have the November number of 5.4%, there is a little bit of a chance that it will be undershot, or a significant chance. Okay, Siddharth, react to that. Should we assume an inflation of 5.8 to 6%? I think the government is assuming 6% inflation in FY16. I would assume March of FY16. What's your take? Are they overstating it, overestimating it?
Well, yes, our numbers are slightly softer than that. And more importantly, irrespective of whatever becomes 1 point estimate in March, the overall average for FY16 still remains just about 5%. And our number for FY17 is also not markedly higher. It remains in the low 5% vicinity. So even if the March 2016 number is slightly higher, we'll tend to think that inflation situation by and large is still benign.
Okay, well, any reaction to what Deepali was just discussing with us, that even if the real GDP is 7 to 7.5, this time because of the GDP deflator, the nominal GDP will come in probably at 6% as the last quarter had indicated. In that case, fiscal deficit will have to be about 20,000 crores lower. Is that also your estimate?
Yes, this has come out as a new challenge that given that the low GDP deflator, nominal GDP is turning out to be significantly lower. So meeting the fiscal deficit target, in that process, it has come out as an additional challenge. Our sense is still that the 3.9% number which the government is still sticking to has a lot of headroom for the government.
Okay.
And they should be able to still meet the numbers.
Some qualitative statements which are coming in on wires, where the report says the economy has made considerable progress, but challenges remain, and says that the retail inflation is likely to be about the central bank target of 6%. So that is mentioned. Again, GDP growth between 7 to 7.5% in terms of FY16. So these are just one more qualitative statement which has come in at this point, where the economy has made considerable progress, but the challenges remain. I just had a question.
They reiterated the fiscal deficit target of 3.9% and the revenue deficit target of 2.8%. Deepali, come in on this. How have you estimated the tax and non-tax revenues so far? Is the challenge only going to be this 20,000 crores because of the changed mathematics of nominal GDP? Will there be more challenges because of revenue collections?
Yes. So excise is clearly surprising on the upside, and I think the biggest upside is from excise. So I think through excise you could get as big as 0.5% of GDP, a kind of an upside. But I think you have to look at it if you put the slippages on the other side. So one is the OROP. The estimate there is not so high, and it seems like they're going to move it to the next year, majority of the expenditure.
Yeah.
Then there is bank recapitalization, something which was not budgeted for initially to begin with. And then, an upside of about 60 to 70,000 crore on excise could easily be offset by the slippage that you're going to see on disinvestments and on income tax. So all in all, it does still look like 3.9 is difficult, despite the fact that excise and a little bit of non-tax revenue because of higher RBI dividend, even if these two were to be taken into account.
Oh yes, that's a solid 65,000 crores. No mistaking that. But I think that would have been factored in their non-tax revenues, because this is a 3-year commitment by the Reserve Bank of about 55 to 65,000 crore dividend. Next year also they will give 65,000 crores. The governor said as much. But then the accumulated profit runs out, and thereafter the profit from the Reserve Bank will depend on the money they make each year. But Deepali, that leads to the next question. If 3.9% is a challenge, will it be met by not meeting the challenge, allowing it to go to 4%, although they say they are reiterating 3.9%, or will they cut plan expense as has been the practice?
Right. I think ultimately it will boil down to that. So ultimately I think what will happen is, compared to next year, we might still be higher on a capex to GDP. So we were looking to do a 1.7% of GDP for the year, up from 1.5 last year. But I think the ultimate actual number could be somewhere between a cut from number to the year-on-year capex that you saw in the first half will come down to something about 5%. So positive growth, but significantly lower than first half.
You expect that will be the government strategy?
Yes, that's right.
Okay, Sanyal, come in on that. That's not looking very good. We were banking on public investment-led growth, and that in the first half was 30% above the 6 months of FY 2015. If that were to fall, first of all, is that your expectation that to meet the deficit they will cut plan expense? And if that happens, what happens to growth in subsequent years?
Yes, in the sense. Very difficult to miss the 3.9% target, given that this itself had been a revised target, and this was not the initial target as per the FRBM path. So I think the 3.9% remains more or less sacrosanct. They would have to do a bit of an adjustment on the expenditure front. Thankfully, the adjustment in Q4 of the financial year this year will still likely be, the adjustment will be somewhat lower than what we used to see in some of the previous years. But yes, had the revenue situation been somewhat better, we possibly could have added a little more momentum to growth, which will possibly have to wait a little more.
Okay, well, some more statements, which is just more qualitative in nature, where the benign fiscal situation and improving external conditions is boosting growth. Dipali, I just wanted to come to you about FY17 GDP projections. How much do you think we can start? The target is 7 to 7.5 for FY16. For FY17, what would the range be according to you?
So what we think is that the cyclical tailwinds that the economy saw this year from lower commodity prices, a significant easing in fiscal stance, as well as monetary policy easing is coming to an end. So cyclical tailwinds remain, but they kind of diminish for next year. And that together with a growth mix which favors consumption rather than investment doesn't bode very well for the trend growth. So sure, there will be acceleration next year. So we're factoring in acceleration of about 20 basis point from this year to next year. But I think the growth mix becomes a little unfavorable to a pickup in trend growth.
Okay, I'm getting another sentence here. Need to reassess the fiscal consolidation aim. But this is looking a little dicey. What do you make of that statement, Dipali? Need to reassess the fiscal consolidation aim. Does it mean that they're going to reconsider next year's fiscal deficit?
Yes, it seems like that. I think, like Siddharth mentioned, that it does seem like that this year's target seems more sacrosanct, but I think that can happen only if a lot of stuff is pushed out to next year. There were some statements earlier as well that even the subsidy burden could not be met with the budget this year, and other things getting pushed out from OROP and a bank recap. It does seem like they will have to evaluate their 3.5% target. In our own estimates, we do think that 3.5% next year will be missed.
Yeah, okay, actually, they are not letting it go. There is a statement saying that they will take fiscal consolidation to its logical conclusion, but do say that the pay commission payout is going to make fiscal consolidation a challenge. So, well, it probably will be met in the budget, but whether the budget estimates will be met by March of FY17 will be an issue. Yeah, go ahead.
Just the qualitative statement, which is again coming in, where it says the fiscal outlook for 2016-17 looks challenging. So like you said, FY16, the fiscal deficit target of 3.9% might be met, but the 3.5% for FY17 and maybe the 3% for FY18 would be something we need to watch out for in terms of the budget as well.
Okay. Siddharth, let me throw a more open question. What we have are actually mostly known issues. The mid-year review hasn't given us anything new. What will you watch out for?
Well, there is, I think the plan on fiscal consolidation or the commitment towards fiscal deficit targets remains something very important because this is coming from the government. And I would put it this way, I still don't think there is too much of risk to the 3.9% number we have this year. We might see some adjustment in expenditure. But even if we see hints to the fact that FY17 numbers will eventually be somewhat different, I think there will be some kind of uncertainty because of that. Because if you see the external world conditions, they have not really posed any challenge to this fiscal consolidation plan. If at all the challenge is coming from pay commission on OROP, these are purely government actions. So there will be uncertainties in the form that government has not really taken into account their own future actions when they had come out with the fiscal consolidation plan for 2-3 years in early 2015. So those things need to be examined, and the government also has the responsibility to spell it out very, very clearly in that case.
Okay. I am getting another sentence from the Finance Ministry saying need to reassess monetary stance on aggregate demand. So probably that's a veiled way of saying we want more rate cuts. You are overestimating aggregate demand. Reassess your stance and probably prepare for more rate cuts. I mean, that is the implication of that statement, Ekta.
Yes, just a couple of more statements that I'll read out from the wires, which is that GDP growth is powered only by private consumption. Public investment is a cause for worry. And the external debt position remains comfortable as of now. And the report also says that need to reassess government's commitment to cut fiscal deficit by 0.4% of GDP for 2016 and 17.
Oh, they reiterated.
Yes, it's
of 0.4%. So they are sticking with 3.5 as of now. Yeah. Well, that is a tall order, especially if growth doesn't pick up. Deepali, what would you look out for? These are about the statements that have come so far. What would you watch out for from the media review?
Right. I think it's really important to see, like you mentioned, what their growth estimates really are, because right now the big unknown seems to be where nominal growth will end up to. I think excise, income tax, their expectations there are given. Then I think it's also important in terms of if what the ultimate subsidy bill they are looking at, because as of now for the current year we're expecting a little bit of upside on that. So there could be a little more higher reduction in subsidies that they had budgeted for. So that could be actually a positive. So that's something I'm looking for.
Okay. Well, the question that really crops to the mind is, if the public expenditure is likely to be cut in the fourth quarter, and if private capex has not quite picked up, if global demand is going to remain anemic, are we in danger of not really doing much better in GDP in FY17? What are you working with, Deepali?
Actually, essentially the entire acceleration, the 20 basis acceleration that I spoke to you about, is coming from private consumption, which is partly led by what happens to the pay commission and the impact from there on, and a further correction down in lending rates as well. And as of investments, I think there is a downside risk to our investment growth estimate, and the contribution of investment will likely stay unchanged, because we're not really expecting any significant recovery in private capex as well for next year. Okay. So yes, next year does look like it will be a little more challenging.
What are you working with? 7.7. Okay, 7.5 this year. Nishchal Maheshwari of the co-head institutional equities at Edelweiss Securities has also joined us. Nishchal, you've had a bird's eye view of all the headlines that have run so far. The growth number has been placed at 7 to 7.5. Fiscal deficit has been reiterated at 3.9. Your first thoughts as an equity investor?
The sound is not very good, but I'll try and answer that. I think you are asking about the 3.9 number which the government has put out for fiscal deficit?
Yes. General comments, yes.
Yeah. So I believe it's difficult. It's going to be difficult basically for them to achieve this. Especially given that around 60,000 crores was the number basically which they had put out to raise it from the stock markets. So I think divestment targets wouldn't be easy to meet for this government given the current conditions of the market. Yes, the tax collections have been good, but so they have over a period of last 1 year, especially the OROP once again is going to take away close to around 12 to 15,000 crores. So I think somewhere there is going to be a stretch for achieving this 3.9 number.
Okay. And if it came in the form of cut in planned targets, which is what our two economists have been worrying about, what would that mean for you as an investor?
So my economist is also worried about that only, that previous 2 years, there is going to be a cut in the planned expenditure. That's going to be worrying basically, because if you really see it, even the government is saying, or we have been experiencing basically, that the demand is not very strong, especially the private one. What was driving the markets, and we've seen some pickup happening, is largely because of the government expenditure. So rather, actually, as an investor, I would have seen it. I would have liked that the government actually doesn't bother about the fiscal deficit in the current year, and goes ahead and continues to invest and do the expenditure rather than actually cutting back and trying to adhere to the 3.9 number.
Okay, I don't think the two economist friends are going to like that advice at all. And if I had a rating agency guy here, he would have almost jumped up and screamed murder. But, you know, I mean, it's really painful to ask our two economist guests to react to these very frugal flashes that we have got from the mid-year economic review. Actually, in a few minutes, the CEA, the Chief Economic Advisor, may start his press conference. Let me thank Siddharth and Deepali on that note and allow them to hear the press conference and then come back with their take. I hand it over to Anuj. I guess you want to keep Nishchal for more.
Yeah, let's do one thing. Lata, thanks a lot for that. Nishchal, stay on with us. We'll just take a quick commercial break, come back and discuss markets with Nishchal Maheshwari, who stays with us.